One of my favorite high yield investments is Morgan Stanley Direct Lending. Now this fund, it's a business development company like Aris Capital Corporation, Main Street Capital Corporation, Sixth Street Specialty Lending, Hercules Capital, Blue Owl Capital, and many others. In fact, it's most like Blackstone Secured Lending, which is its closest peer in terms of its constitution and how it's broken down. But I really like this BDC. Its ticker symbol is MSDL, and yet it's performed quite poorly recently. If those of you who have been following it can see its stock chart has really plunged. Why is this? Well, in today's video, I'm going to discuss why that is, why I think the market has a massive disconnect here, and that there's a huge opportunity in this now 11% plus yielder, and why I've been buying a lot more recently. Before I get into the video though, if you like getting content about dividend investing, whether it be ETFs, CEFs, individual dividend stocks like this video is about, my personal philosophy on investing, how I manage my portfolio, please give this video a like and subscribe to my channel for more content like this. Thank you very much. All right, back to Morgan Stanley Direct Lending. So as I mentioned, the stock has been plunging a lot recently, and there are some reasons for this. First and foremost, the net investment income coverage ratio of the dividend has gotten razor thin. This past quarter, they generated 50 cents in net investment income per share, and that's what their base dividend is each quarter. So based on that logic, there's no more wiggle room. Now, they had the same issue previously, but the company was under levered. And so the thought was, well, they're going to increase leverage, and that is going to help offset potential other headwinds to keep the dividend afloat, potentially give them a little bit more wiggle room. Additionally, they had a debt maturity that was at 7.55% interest rate coming due that they were going to pay off, and the idea was they were going to refinance that with a lower interest rate loan that would then provide an additional tailwind. Well, turns out they've now brought their leverage up to the lower end of their target range. They've also paid off that debt, refinanced it with a lower interest rate loan that they've also flipped to floating, which helps to hedge against future interest rate reductions by the Fed. But yet this quarter, they still had this issue. And so that begs the question, okay, is a dividend cut coming soon? And on the earnings call, when asked about it, management pretty much said, yeah, we're not going to circle the wagons around the dividend. We do have a few extra levers we can pull, which we'll get into in a minute, to support the dividend, but we're not going to die on that hill trying to save our base dividend. And that contrasts with some other peers that have made it clear that, we have all this spillback income. We're going to tap into that to support the dividend, even if it means eroding our NAV. And so different philosophies, but ultimately the market doesn't like the uncertainty. They don't like the prospect of a potential base dividend cut for MSDL. And so they've been putting the stock in the penalty box. I think another big reason why MSDL is so heavily in a penalty box right now is simply due to the fact that when they went public, it was right before the Fed began cutting interest rates aggressively. And it was also right as spreads in the sector were beginning to compress materially. They went public early 2024, and last year the Fed pivoted to rate cuts, especially right before the presidential election. And they also, again, there was a lot of spread compression in the space that's continued on to this year because there's so much capital flooding into it from all these people who are interested in private credit. You have all these major asset managers like Blue Owl Capital, Blackstone, et cetera, that are raising a ton of money, and they're just pouring it into the private credit space. And so that's causing a supply-demand shift that's more favorable towards borrowers than lenders. So it's pushing down the spreads. And so those are some major headwinds that MSDL has dealt with. Whereas in contrast, you look at, for example, Blackstone Secured Lending, which has a very similar portfolio to Morgan Stanley's in terms of its structure. It's overwhelmingly focused on first lien senior secured loans. Virtually all of its portfolios in it, just like Morgan Stanley Direct Lending, has a very similar fee structure. In fact, it's identical, except for MSDL actually has a slightly more shareholder-friendly fee structure because they don't charge their base management fee on cash on their balance sheet, whereas Blackstone Secured Lending does. Otherwise, they're identical fee structures. They both have, reputable managers. Blackstone Secured Lending has Blackstone. Morgan Stanley Direct Lending has Morgan Stanley. Both of them very highly regarded external managers. And so, there's a lot of similarity there. They both have managed to keep their non-accruals very low. They've had very strong underwriting performance. And they both have razor thin, both of them have 100% payout ratios, razor thin dividend coverage. And so there's no difference there. And in fact, Morgan Stanley actually has much lower PIK or payment in kind income as a percentage of its total net investment income relative to Blackstone Secured Lending. So in that sense, Morgan Stanley Direct Lending's income is actually, you could argue, is higher quality than Blackstone Secured Lending's is. So there's an argument for MSDL actually should have a higher valuation multiple than Blackstone Secured Lending. Yet MSDL trades at a mid-teens discount to NAV, while Blackstone Secured Lending trades at about a 10% premium to NAV. That's a huge, it's about a 25 basis point difference in terms of how they're being valued, like, or 0.25 turns, I guess you could say, relative to how they're valued. And that's a massive valuation disconnect, given that they are so similar fundamentally in terms of their underlying performance and their underlying qualitative standpoint. In fact, Morgan Stanley is very well aligned with shareholders. Insiders own a decent bit of the stock, including shares in other funds that hold similar investments or even identical investments that MSDL holds. The CEO just the other day bought several $100,000 worth of stock around the current price. And then, of course, you have Morgan Stanley itself has an over 11% equity stake in MSDL. Now, I'm sure BXSL has insider ownership as well, but Blackstone does not have that degree of a stake in Blackstone secured lending. And so Morgan Stanley actually is better aligned with shareholders here. So again, another reason to really like MSDL over BXSL, yet there's that huge valuation disconnect. And really the answer is because, again, Morgan Stanley, when they launched, it was right as they were going into a period of headwinds, whereas Blackstone secured lending, they launched earlier and were able to build up some goodwill with the market while rates were still rising, while spreads were not yet compressing. And so they were able to actually raise their base dividend a few times. They were able to increase NAV per share and build up that track record that earned them a higher valuation multiple. And so that's really the only way I can explain it. And that tells me that Morgan Stanley direct lending has an incredibly compelling opportunity ahead of it for investors who are willing to buy now and be patient and even weather a slight dividend cut. And here's really the big picture. Why? So, they pulled those levers that I mentioned earlier, and yet their, dividend payout ratio is at 100%. Well, a lot of those levers haven't really fully kicked in yet. For example, they paid off their debt toward the end of the quarter. So that really is going to be more of a Q3 event in terms of the savings on interest cost from paying off that debt. Meanwhile, if rate cuts kick in, yes, it's going to hurt them overall because the vast majority of investments are in floating rate debt, just like BXSL, most other BDCs, but the vast majority of their debt is also floating rate. And so that's going to help offset a lot of that. Not all of it, but a lot of it. So that will help blunt the hit to a net investment income that they're going to suffer from that. And then, so for example, every 100 basis points that the Fed cuts rates, they will have about a 5.4% hit to their net investment income. That means they'd lose about 2.5 cents, 2.7 cents per quarter in net investment income based on their current net investment income levels. And so, that's for a 100 points basis cut, which is pretty significant. Probably won't happen in September. If they cut rates, it'll probably be 25 or 50 basis points. So that's going to be probably over at least in the rest of the year, maybe even in the next year, that 100 basis rate cut would take place. And so that gives them time to build up some additional income to help offset that. And again, they're going to get that from their refinance debt, which really hasn't shown up on the balance sheet yet. They've also recently done a CLO pricing that should give them some lower cost debt. And again, they also have very low non-accruals. And so there's a sense there where, they're not going to be suffering a headwind from underwriting losses. They have a good bit of spillback income, about 85 cents roughly per share of spillback income relative to their 50 cent per quarter dividend. That gives them additional income they can tap into there as well. Now, of course, that would slightly erode NAV, but management indicated they're willing to tap into that, at least potentially some, to help support the dividend through a transition period. And so those are some factors to be looking at that could be propping up the dividend moving forward. Additionally, because they trade at such a huge discount to NAV, they are implementing a fairly aggressive programmatic buyback program. And so they're able to buy back shares at a discount to NAV, which is accretive to NAV, which gives them that extra buffer to potentially tap into NAV to use some of their spillback income, and also, of course, increases their NII per share whenever they buy back stock. So that's another little tailwind to keep an eye on. And again, who knows what's going to happen with spreads? They could end up widening again, or at the very least, they see some bottoming taking place there. And there's always the chance that, Morgan Stanley, through their underwriting efforts, can potentially bring in some attractive investments that they may be able to invest in, maybe a joint venture or something like that, to be able to slightly juice the yield a little bit. And they do have some wiggle room still on their leverage. As I mentioned, they're at the low end of their leverage. And even this past quarter, they increased their leverage over the course of the quarter. So their average leverage was even lower than their quarter end leverage. So that's going to be an additional tailwind moving forward. So I think that they should be able to support the base dividend, at least through the end of the year, barring some dramatic rate cuts that are just crazy, and even into next year. And there's a chance that they could even skirt through, just depending on the degree of aggressiveness and the pace at which the Fed cuts rates. But personally, I'm expecting them to cut their dividend slightly early next year, but I don't think MSDL is going to be penalized too severely for it, because I think many of their peers are going to be in the same boat. And so I don't think MSDL is going to stick out as, they're a unique BDC that's cutting their dividend. Let's penalize them. I'm sure there'll be some that will skirt through that probably won't cut their dividends. Like I doubt Main Street Capital will have to cut it. They got a pretty conservative payout ratio. ARCC Capital Corporation will probably do everything they can to not have to cut. They'll probably skirt through, and there'll probably be a few others as well. But again, Morgan Stanley yields over like almost 11.5% now. So even a 10% rate cut, still going to keep them over a 10% yield on cost today. So that's pretty good, I would say, given that you're buying a business with a strong balance sheet. That, by the way, they have like very little in the way of debt maturing in the near future, whereas others like Blackstone Secured Lending and ARCC Capital Corporation actually have quite a bit of debt maturing. Their debt is almost all floating rate, so it's going to be going down in cost with rate cuts. Again, very defensive portfolio, exceptional underwriting, very small watch list, very low PIK, very attractive fees relative to other externally managed BDCs, high quality external manager that's well aligned with shareholders. Again, what's not to like? So what if there's a little dividend cut? You're still going to get a 10% yield on cost probably, even if they have to cut, say, by 10% to offset, 100 basis points of Fed rate cuts. So again, I think it's a strong buy today. I recently bought more this past week, and I hope you see it the same way. Let me know in the comments below what you think of MSDL. I made this video because a subscriber asked me to make it. So here's my update. Again, if you like this content, please give the video a like and subscribe to my channel for more deep dive analysis like this. Thank you very much. See you next time.